It's a Tuesday night. You're sitting on the edge of your bed, scrolling through your phone, and you get a text from your landlord. The water heater's gone. The plumber needs $1,100 to replace it, and they need it by Friday, or you're taking cold showers through the weekend. You stare at the ceiling for a second. You do the math in your head, the math you've done 100 times before. Checking account, credit card limit, that savings account you keep meaning to fund, the Venmo balance, the retirement account you swore you'd never touch. And here's the part that doesn't make sense. You have a job, a decent one. You're not lazy, you're not reckless, you don't blow money at the casino. You went to work this morning, you'll go to work tomorrow, and somehow $1,100 on a Tuesday night feels like an earthquake. So how does someone earning a real paycheck, doing everything they were told to do, end up Googling personal loan same day at 11 at night? This is Rocket Finance, and today we're going to talk about what actually changes when you start saving money. Not the motivational version, the version with real numbers, real research, and a real answer to why this keeps happening to people who, by every reasonable measure, should be fine. If you'd rather understand the mechanics than be guilted into a budget, hit subscribe and stick around. Here's what nobody tells you. The reason you don't have $1,100 sitting in an account is not mostly a character flaw. It's a system that was built around you spending every dollar you earn as quickly as possible, with as little friction as possible. Your bank wants your checking balance high, so you swipe more. Your credit card company wants you to treat the card as a backup plan, because when you carry a balance, they make 20% or more on it. The entire payments infrastructure, from one-click checkout to buy now, pay later, is engineered to remove the pause between wanting something and paying for it. You are a rational person navigating an irrational system, and the system is profitable precisely because you don't have a buffer. The numbers back this up in a way that's almost embarrassing. Bankrate found that only 44% of Americans could cover a $1,000 emergency from savings. More than a third would borrow the money. The Federal Reserve's 2024 report on household well-being is even more stark. 18% of adults said the largest emergency they could handle with savings right now was under $100. Not 1,000, 100. And 13% said they couldn't cover a $400 expense by any means at all. Picture a 31-year-old marketing coordinator in Columbus, making $62,000 a year. On paper, she's doing fine. In practice, her checking account hits $140 2 days before payday, every payday. And when her car needs new brakes, she puts it on a card at 24% APR. She's not bad with money. She's exactly average. Now here's where it gets interesting. Vanguard ran a study of over 12,000 of their investors, and they found that the single biggest jump in financial well-being didn't come from a six-figure portfolio. It came from having $2,000 in emergency savings. People who hit that number reported financial well-being 21% higher than people with nothing saved. They spent 3.5 fewer hours a week thinking about money. Half as many of them reported rising financial stress year over year. $2,000, not a year of expenses, not 6 months. $2,000 changed how their brains worked. A 47-year-old warehouse supervisor in Phoenix, earning $58,000, told a Bankrate survey he hadn't slept through a full night in 3 years. 6 months after he hit $2,100 in a separate savings account, he said he stopped checking his banking app at red lights. Same income, same bills, different nervous system. The Fed's data points the same direction. 55% of adults said they had 3 months of expenses saved, and that group reported dramatically higher confidence about everything else in their financial life, including retirement, which they were not actually saving more aggressively for. The buffer didn't just protect them from emergencies, it freed up bandwidth. And that word bandwidth is the key to why this is so hard. There's a body of behavioral economics research, most famously from Sendil Mullainathan and Eldar Shafir, showing that financial scarcity acts as a cognitive tax. When you're constantly tracking whether rent will clear whether the card will get declined, whether you can afford gas until Friday, your brain is running a background process that drains the same mental resources you'd use to plan, to negotiate a raise, to compare insurance quotes, to read the fine print on a loan. Studies estimate the effective IQ cost of financial stress at around 13 points. That's the difference between a normal night's sleep and pulling an all-nighter. So when someone says just save more, what they're actually asking you to do is make a long-term, high-discipline decision while your brain is being taxed by the absence of the very thing they're telling you to build. It's like being told to lift weights while someone stands on your chest. This is why the $2,000 number matters so much. It's not that $2,000 solves your problems. It's that $2,000 turns off the background process. It gives your brain permission to think about something other than survival, and that's when better decisions actually become possible. Go back to that Tuesday night. Phone in your hand, water heater quote on the screen. The version of you with $2,000 in an account labeled something like "Do Not Touch" pays the plumber, goes to bed, and forgets about it by Thursday. The version of you without it loses a week of sleep and pays 24% interest for the next 8 months. Here's the plain takeaway. The first $2,000 you save is worth more than any $2,000 that come after it. Because it's not buying you a vacation or a retirement, it's buying you your own attention back. You are not failing. The math is broken, and the system was built assuming you wouldn't notice. Now you have. If this reframed something for you, hit like, subscribe, and we'll keep going. This is Rocket Finance.